I think we are on to the second session. First session, you remember that first session I dedicate for introduction of risk management. Introduction of risk management, we initially started what is risk, and then we went to the process of how do you manage risk. We also touched various aspects of risk, what financial institutions generally uh, undertake. If you can remember, I said uh, in my risk management definition, I said risk is an uncertainty in which the probability will be our objectives will not be achieved. Say in financial sense, our objective is to make profit. So when uncertainty or the risk arises, that may turn into loss. So if I am to say what is risk is, it's a probability of making a loss in an objective where we had the objective of making profit. Uh, Financial management require to take risk. If you are in a financial services business, if you don't accept risk, that means you stop lending. Then all your deposits get accumulated, and you have no income. Therefore, you need to take risk. And I also went on to describe you the process of risk management. You know what is management is. Risk management is also a process. In that, I said the first item we need to manage is identification of risk. So this is a vast area. You need to do various things to, depending on the type of risk, you have different methods of identification. For instance, if it is credit risk, in generally your business unit identify risk by doing a proper evaluation. If it is in market risk, you have various other methods. You look at the history of how an instrument has changed in price. For instance, market risk of having a commodity of, say, gold, you look at last 5 years, how market has changed in the gold prices in the world market. So that kind of identification you need depending on the type of risk you undertake. Then we went on to describe, to sum up what we have done, we also looked at the type of risk financial institutions generally undertake. I divide that into four main areas. That is financial risk. Financial risk, again, I divide into three other areas called credit, market, and liquidity. Then the next type is operational risk. You know that we need to do operations of all our processes, and which need people, which need systems. And also our operation could hamper by various events, either internal or external. So this risk of having failed systems will be managed under operational risk. Part of operational risk is now in the present sense because banks now have various different channels of distribution of their services. For instance, those days it is only there's one channel. That means you need to get it to a branch bank to do your transactions. Now it's not that. Now you could reach an ATM. You could log in through your own computer and use internet banking. You can take your mobile device and also you can connect your bank through phone banking. So these type of channels, delivery channels, provide additional risk. So those risks, we call it information risk, and information risk is also part of operational risk. Then I also looked at another kind of risk, we call it strategic risk, because we operate in a very dynamic economic environment. Now I think under the present situation of COVID, we are even more stressful in our business activities. Your borrowers will have problems of prepayment. Also, businesses have been closed. As a result, banks will have a lot to do when it comes to strategy. One of the strategies to promote online banking. When you promote online banking, you need to safeguard your data and your systems. Then you get into information security risk. We also, under strategy is involved between your customers and your competitors. What you do best, your competitor will copy, and therefore you need to have a better service arrangements than your competitors to get your customers to your own bank. Therefore, you need to formulate certain strategies. Strategies in a bank compared to any other institution can be copied very easily. That means we also work on a similar product, similar interest rate regime. Therefore, even if you increase the interest rate on your fixed deposit, your competitor bank will tomorrow also will advertise that they also have increased. Therefore, your advantage of trying to get advantage over your competitor will be lost. So strategic risk is very important. Under the strategy, you will generally, all the banks will have a strategic plan. Some strategic plans are on a long term. They might even budget their revenues and various key indicators of progress for next 5 years. So that is based on strategy. Risk management also will have to get involved in formulation of these strategic plans. So strategic risk also a part of a major risk in institution. Then I draw 3 circles. In between I had a yellow hub. In that yellow hub I named it as regulatory risk, because I also pointed you out that we are different from a normal corporation. Normal financial institutions rely on customer confidence to get deposits, and customer confidence will come only if someone give them a understanding that these particular institutions manage their risk and their deposits will be safe. That assurance will come from our regulator. Our regulator is Central Bank of Sri Lanka. So they also provide directions, and also they insist on certain compliances. So we call that particular portion is regulatory risk or the compliance risk. Compliance or the regulatory risk arises if you don't obey the directions and the instructions issued by the regulator. So those are the 4 major risks. Apart from that, I also mentioned about reputational risk, technological risk, and legal risk. So these are the type of risk financial institution generally may need to look at in managing their business activities. Today, we are going to move into another area which is called integrated risk management. Now, when you have different type of risk, namely financial, operational, regulatory, and strategic, in single transaction, you can identify several risks. So I'm going to do a small exercise. And in that exercise, I want you to just have a piece of paper and write down this small exercise which I'm going to give you. I can also put it on the board. We'll say you are an employee of a bank. Okay, let me give a name to your bank. I will put the name as Bank Downtown. Actually, the meaning of downtown is a bank situated in the heart of your capital. So, if you are in a state or a country, when you say downtown, it is not the suburb, it is the central part of that capital. So, this particular bank is situated in central part of your capital. So, I named it as Bank Downtown, and it accepts like any other financial, it accept deposits. Generally, the folks in the capital, they don't want to invest money on a long term. So we'll say most of your deposits, the duration of deposits is limited to 2 years. So we'll take an example. You have a customer who has placed a deposit of 1 million for 2 year term. So on your deposit side, I said banking is a business. You have economic agents who have excess money, they will deposit the bank. So similarly, now this downtown has a customer, he's an economic agent. He has deposited 2 million rupees for a duration of 2 years. Then we'll take on the other side of your balance sheet, there is a customer who comes and say, um, I need a facility of 1 million repayable over 4 years. And generally, based on their business requirement, the duration changes, and this particular customer, his repayment capacity is more suited to repay that loan in 2 years or 4 years. And we'll assume you use the funds what you got from these 2 year deposits as source of funding or lending of 4 year loan. Now I want you to, I'll go to the screen and show this example. So this example is you have bank downtown, you have a deposit of rupees 1 million, term is 2 years, you have a loan rupees 1 million, 4 years. Now, I'm going back to my slides, but you may have seen what I have put on the board. Now, in the board, I mentioned you have a bank, you are a bank, and in that bank you accept deposits, and the deposits of 1 million has been accepted for a 2 year term, and you have lent that deposits for 4 year term. Now, based on so far what we have learned, in this particular transactions, I want you to identify type of risk bank will be subject to in these particular transactions. Of course, you have two sides on the balance sheet. On the liability side, a customer has made a deposit. On your asset side, you have lent a loan of 1 million, similar amount, for a longer period than your deposits. Now, yes, any questions? Now, can you identify what type of risk the bank will be subject to? Mainly, you have lent money. So I told you the major risk is a financial risk because this involves, based on what we have given on the board, we have a transaction in that apparently two transactions. You accept a deposit for 2 years and a loan given for 4 years. We'll take the asset side first. That means you have lent a loan of 4 years. What risk you will undergo? I said we are a financial institution. One of the major risks under financial services or financial institutions is the financial risk. Financial risk, I divide financial risk into another three parts called credit risk, market risk, and liquidity. Now we have a situation as a transaction where we have lent 1 million rupees for a 4-year term, keeping the source of funding is a 2-year deposits. Now what happens here is you lend money for 4 years, and one of the major risks that could happen is if a customer default. That risk is we call credit risk. Now on the asset side, you have one major risk because you have lent money to a customer. In case if he defaults, you have a credit risk. Now there can be various other risks. Now say when you grant this facility, just consider that you have not taken proper documents. And as a result, when this customer defaults, you have the credit risk, but you may not be able to recover because based on your security documents, you have not executed them properly. That sort of a risk is, we call it operational risk. So in this asset side, we already identified two types of risks. So in credit, if a customer is unable to pay or he's unwilling to pay, however, you have executed all the documents in order, and as a result, you may use various other recovery methods to recover. But if you have not done your documents proper, you will have this, not only the credit risk, you will have operation risk. Now, I also told you accept deposits for a 2 year. Now, that day also I said, keeping in reputation, this customer who deposit for a 2 year, after 6 months he comes and says, look, I got a very urgent financial need. I would like to draw this money out. What happened? To keep in your customer confidence and also reputation of the bank, you will allow him a premature withdrawal. What happened then? Your source of funding for this particular loan was made out of that premature withdrawn deposits. Now you don't have source. You may have to get another deposits to fund this. That type of a risk is we call funding risk. And premature withdrawal also will affect your liquidity because you don't want to keep additional funds just in your current account and receive no interest. So you always try to allocate the deposits to another lending transaction, so you will continuously earn interest rate above the deposits. Now, if you have to keep that additional funding, uh, that additional funding by handing a deposit back, you are short of funding. So when you don't have liquidity to fund this particular transaction, other deposits are not coming through, you will have a position of liquidity risk. So we looked at, on one side, on the credit side, we looked at credit risk and operation risk. Now, premature withdrawal will give you funding risk and also liquidity risk. This premature withdrawal of deposits we also call embedded risk in the bank. So in fact, we have 5 types of risk in this particular transaction. Now, therefore, your regulator says you cannot consider a transaction and identify just one type of risk pertaining to that particular transaction, because they can get integrated. As a result, central bank has come up with, this came up in 2011, they came up with a roadmap to get all the risks faced by the banks to an integrated framework. And they call this, through this framework, only all the transactions of the banks are managed. It can get, in a single particular transaction, you can get different type of risk. As a result, integration is required. We also call it holistic management, or I also can give another word called have a helicopter view of what's happening in the bank. That means you have a overall look at a transaction and identify different type of risk that get involved in that particular transaction. So central bank came up with the guideline, and it's called a direction, and that direction is named as integrated risk management framework. So I have already given this integrated risk management framework. I'll switch the slides to one of the documents which I shared with you, and in that document you can go to page number 200 and let me get the document and show you. Yeah, page number 246. Direction number 7 of, no, just a minute. I have to go further down. Yeah, in fact, page number 248, and the direction is called Banking Act Direction number 7 of 2011. You can see integrated risk management framework for licensed banks. These particular documents you need to go through carefully. Probably you might not understand initially, because when we progress looking at each type of risk in very much detail, you will understand this document proper. So this was the guideline given to all licensed banks to manage their risk. So we call it integrated risk management framework. And today we are going to actually look at this particular aspect. So I'm not going to go through this. So I'll go back to my slide again. So it says, like in management of risk, integrated management is also a management process. Now you can see affected by the board of directors. So they have given big responsibility. They have identified the people who should manage this risk. They have identified the board of directors' involvement in this particular process. And it also says board of directors, management, and other personnel. That means it has to be managed right across the bank. We say top down and also um, bottom up, and also we say right across the bank. Applied in strategy setting. Now, say if a bank wants to create certain strategies to compete with your competitors and to acquire customers, they also must apply those strategies in line with this particular framework, because some of the strategies might result in huge losses. So risk management will have to get involved in bank strategy. Now, say if a bank wants to develop a new banking product, and this banking product, as per their strategy, they think will create a advantageous position for this particular bank over their competitors. But however, this will be generally a new product will be developed by your marketing department, but they are not very thorough with the regulator, or they are not thorough with the risk get involved in providing this particular product to your customers. So in this framework, allow any new businesses or new product development risk management to get involved. So it says applied in strategy setting and across the bank, designed to identify potential events. That means risk management involve consider future events which you don't have right now, but like we had this COVID-19. It's a potential event which actually hampered all the banks. So in this framework, it also gives a provision for you to look into the potential events that will come under a section called stress testing. So we will have a thorough session on that. How do you stress test your bank's potential events? Then you will know what it is, what is the importance of stress testing. And it also then it says, and manage risk within this risk appetite. Now you have to understand this terminology, because in risk management we use certain terminology. One of the term what we used is the appetite. The appetite generally is related to food, but here we are talking about risk appetite. Risk appetite is the amount of risk which you are going to take in a transaction. Now, for instance, if your bank thinks that we should lend to a particular sector, and in that sector, there's amount of risk. We'll take, for example, we'll take a product, leasing. Your strategy says all the others are actually promoting this particular product. Why don't we also get in and give a lot of thought for this product? So it will go to the board, and board will say, okay, based on recommendations, in next 6 months, our appetite for leasing is much higher than what we thought originally. And then they will say, okay, you promote leases, and then advertising campaigns will start, various other things. You get your staff get assigned to various functions to promote leases. We say that particular moment, originally if your leasing portfolio is say 10 million, when that recommendation comes, your board will think we will have a higher limit of leases in our portfolios, and They might even put a limit. So leasing limit will be, say, from 10 million to 20 million. So your appetite has changed on upward trend. That 20 million is also a benchmark. When you say benchmark, we also apply another term. We call it your tolerance level for this particular product is 20 million now, from 10 million to 20 million. But once you reach 20 million, you have reached your tolerance level. That time your board might say, okay, maintain that level. We don't want any further leases because we want to have a diversified portfolio. So two terminologies I used here. Risk appetite. Risk appetite is your um, willingness to take risk on a particular product or a particular region of lending or particular industry. Then you set a limit that we call it a tolerance limit. So risk appetite and risk tolerance are two terminologies we learn from this. It says to provide reasonable assurances regarding achievements of bank's objectives. So integrated risk management is, as I told you before, it is to have a complete helicopter view of all type of risk under one framework. Now, if you go through back again to this particular uh, direction, I'll go to page number 248 once more. You read this, the first sentence, in order to ensure soundness of banking system, the Banking Act, last amended Banking Act was in 2006, empowers the Monetary Board to issue directions to licensed commercial banks. So we'll go to the first para under that. All licensed banks shall adopt a specific integrated risk management framework in compliance with the guidelines annexed. That means these guidelines request all the licensed commercial banks to set up a framework which is called IRM or Integrated Risk Management. Then it also says this particular document, we also call it a well compiled document. All the central bank will later, like when they visit you on an inspection, first they will ask if it is to be visited your risk management department. They will ask, could we see the risk management framework adapted by you? So you will have integrated risk management policy document, and this policy document should give all what is required by the central bank. It says framework which shall documented shall cover various potential risks. Now we looked at certain type of risks. Potential risk are credit, market, liquidity, operational risk. You will have regulatory risk. You will have strategic risk. Then also you can have legal risk, technology, and also reputation. So you have to cover all these type of risk if your bank get subject to. So this particular document should speak of all type of risk what bank undertakes. Mechanism of management, information and reporting to identify and monitor such risk. So that means they also want you to talk in this particular document or state in this document how do you have your processes to manage each type of risk. And also it says effective measures to control and mitigate risk. Another term here we have mitigate risk. Now today we touch risk appetite, risk tolerance. Now I am talking about risk mitigation. Mitigate means to control to a certain extent that you will not have a loss. So in this particular document, you must have risk mitigation techniques. So we will discuss all these techniques when we take each type of risk, how do you manage. Then it also says you should have prudential levels and relevant officers and committees responsible for such control and mitigation. So basically, this particular framework should be approved by the board of directors. So central bank says your board of directors involvement is necessary, because once the risk management framework is done by the risk management department, it has to go, your IRM policy document has to be approved by board of directors. Board of directors shall assess the integrated risk profile of the bank and its management at least quarterly. Now I am going to talk about another structure. Every bank was asked to set up a board subcommittee to manage risk. And this subcommittee is called BIRMC. That means Board Integrated Risk Management Committee. Now say IRM stands for Integrated Risk Management. You put B in front, then it will become board. After M you put another C, then it will become BIRMC. So Board Integrated Risk Management Committee is the one who is responsible to look at least on a quarterly basis to all type of risk a bank can undertake or subject to. So when this was issued, the central bank wants all the banks to follow this instruction within a matter of 6 months. So we'll go to the subject of integrated risk management once more. So you need to understand the identification here. It's a management process affected by board of directors, and I would put here not just management, we call them key management personnel, KMP. KMP stand for your corporate management and other personnel, those who are in risk management, applied in strategy setting. So we will talk about in details how they looked at this. So integrated risk management framework, it includes a set of principles that will reinforce, protect this culture. That means these principles we are going to list in this particular framework document are 3 types. One is, we call it risk management policies. Then we also call risk management processes or the procedures. Then the third one is, we call it risk management structure. So all these 3 items, the policies, the procedure, and the structure of managing risk on an integrated way and put that into a particular framework or document is, we call it integrated risk management framework. So it also says it covers potential future risks, possible source of those risks, mechanism whereby management information. So it is similar arrangement which I explained to you. So it also says this framework is a well-defined document, and it should be very comprehensive enough to capture all type of risk. Now you learn several type of risk in our first session, and this document should cover how do you manage each type of risk. And it also says process and the system or the procedure to manage risk. So as I told you, the second part is scope here means the policies. How do you set up policies to manage, to cover risk comprehensively? And then it says what are the procedure you follow The procedure is, we also say the management procedure to identify, measure, acceptance, monitor, and control and report. Here we have mentioned monitor, identify, measure, acceptance, monitor, and review, which is the same. So procedure of managing risk also will need to be embodied in this particular document. It also says responsibilities of individuals involved in the risk management. So you need to have a clearly defined structure. So we are talking about a framework which have policies, we have procedures, we have structure. So we are going to look at what it is, and initially I'm going to look at the structure of a bank. And on top you can see the board of directors, and we call this structure in risk management is called 3 lines of defense. To manage risk in a bank, you need, I said, it has to be a oversight of your board of directors and the involvement of key management personnel and also other personnel, which include your business line, your risk management line, and your risk assurance, we also call it audit line, to manage the various type of risks which undertake. I'm going to talk about the first line of defense. The first line of defense is limited to the guys who are actually facing customers. Anyone who is originating a transaction belongs to this first line of defense. We'll take an example from the army. In a battle, you will have various battle lines. You don't have generally the commander who actually plan and implement the battle right in front. They put soldiers who doesn't have much experience, but they are given arms training and they are put on the battle line. Similarly, in banks also, we have our junior staff who are at the counters. So they undertake various transactions, and those transactions involve various risks. So therefore, it's very important that risk management process has to be informed to them through various circulars. So a person who is going to process a transaction generally need to identify a method or the procedure, a laid down procedure how to undertake a transaction. We'll take for an example, if you are going to give a loan, a guy who is at the counter may not be the right person who should actually decide on whether to give this loan or not. So what the junior officer who is actually interacting with the borrowing client initially, they will have preliminary interview with the client and get his requirement. And that requirement, to support that requirement, this particular staff member will ask various type of documents. We call this process information collection. And he will hand over application of credit, and generally most of the banks on this application itself give guidelines what sort of documents should be attached in final application. So who is at the front, at the battle front, is the staff member who is at the counter or at the desk of processing this particular facility. Will have a slight knowledge, will not have a very thorough knowledge about how do we process the transaction, but it's a information collection functions will be carried out there. But for that also you need to tell or inform this particular staff member at the battlefront first. If a customer comes for a facility, this is the form you should give, and in that form customer need to complete and provide us with supporting documents. Then it will go to evaluation, or we call it a credit analyst in some banks. Some banks is the credit officer. Credit officer knows the type of risk generally in a particular borrowing credit line involved. So then probably this going through the documents what he has collected, this officer will have an interview with the customer. In that he will get additional information in order to evaluate this particular transaction. I'm going on the first line of defense, which is your business line. Then finally on top you will have your approving authorities of this facility. Approving authorities can be a branch manager or your regional manager. If he doesn't have the delegated authority to approve that, then it will pass on to your head office. Head office will have a credit committee. It might go to CEO. If CEO's DA is also not sufficient to approve this facility, it might even go to the board of directors. So along this line of first line of defense, we call this risk ownership. They deal with the customer, they do an evaluation. This process was the one prior to risk management was introduced. This was the process we followed in banks. But now once the risk framework has been introduced, you get another unit after that. We call it second line of defense. Now second line of defense start with different type of risk units. Now we talked about a loan. Different type of risk unit include market risk, credit risk, liquidity risk, operational risk, compliance risk. So these 5 units come under the supervision of Chief Risk Officer. Now, if a business line undertake a transaction to process a loan, what do they do is this particular second layer where a credit officer prepare an appraisal form. When he send the approval of that appraisal form, they will submit a copy to the second line of defense, which is risk department. And since it's pertaining to credit, it will go to this particular unit of credit risk. And credit risk also will do an evaluation and give the recommendation through Chief Risk Officer before we approve this facility. So we have another line of defense in our structure. What does this particular line? They also, since they are managing risk, all these market risk, credit risk, liquidity, and operational and compliance risk will report to Chief Risk Officer. Chief Risk Officer sometimes can go direct to the Board Integrated Risk Management Committee, which I told you, BIRMC, or in between you can have various other executive committees in a bank. Most of the banks will have a credit committee. In between, you have a credit risk management committee, you will have a market risk management committee, you will have operational risk management committee. In between, in these committees, CEO will participate along with the business unit. So there will be information sharing about bank's overall risk. Finally, they will get escalated to the Board Integrated Risk Management for their knowledge, oversight, and approval. So in our structure, we will have the second line of defense, which is the risk department. Apart from that, all the banks, we had this particular third line of defense, and that line of defense is called the audit line, or they will give assurance to the board of directors or to the senior management that your business units follows all the instruction given to them in processing transaction. Banks will have various manuals. We will have operation manual, we will have credit policy manual. So these manuals will give directions to the first line of defense to execute their transaction. Internal auditors will time to time will visit the business units, branches, or your department in the head office, and they do an audit. In that audit, what they check is whether these business units or the first line of defense has followed the instructions already approved in the bank, and we also call them internal controls. And if internal controls are adhered, that little bit of the risk what you encounter, especially in operation risk, can be minimized. So generally in banks, not only internal auditors, now we also have external auditors going through our books periodically to give assurance to the board. Board also have like PIRMC for credit. We also have audit. We have another board subcommittee called Board Audit Committee, and they will report to this particular committee, and that committee will report to the board of directors. So in our framework of integrated risk management, I only so far touch on the one aspect of it, which is the structure. And even regulators recommend this sort of structure in your uh, risk management framework because it has the risk owners, it has also risk controllers, and there's another unit which give assurance to the board of directors. All the risks undertaken by the bank are properly managed based on the policy guidelines issued to them. So this structure is very important, and generally when you have a structure of this nature, your risk management frame will get strengthened, and your objectives of making profit can be achieved. So that is the structure. Then we looked at we only looked at risk management in a financial institution. But if you look at in another company, after Enron collapse, when I mentioned about history of risk management, internationally another framework came, and instead of naming it IRM, integrated, they call it enterprise risk management, ERM, and this can be used in any other company. Like international integrated risk management, this particular framework also formed by a committee of some standards, not by a regulator of financial standing, and it also looked at event identification, risk assessment, risk response, how do you control, and information and communication, which is kind of risk reporting, all that they also talk about before our IRM policy framework was being. So it says ERM or enterprise risk management is also a process. Similarly, we also mentioned IRM also process affected by people. Here, what the people is the executive committees of that particular company. Now, in banks, we said affected by board of directors and key management personnel, and also other personnel. Other personnel is those who are in the business line. In applied in strategy setting, now we also looked at when we are developing a new product as a strategy, risk management will have to get in. So ERM policy, which was enterprise risk management, which was introduced even prior to IRM, also looked at this. It also says it applied across the enterprises. We also said upward, downwards, and also across. So across the enterprise, so information must flow through to all people. Is designed to identify potential events, which is very similar to our stress testing. Manage risk within a risk appetite. Now you see, even ERM will also should give a statement called risk appetite, a term what we used to identify amount of risk we would like to undertake in a particular product or particular industry or particular region. Is similarly ERM also stand for that. Then we also have, it also provides reasonable assurance. you remember our structure. We had the audit committee and giving a certain amount of assurance that all the risk management policies have been followed by the business unit. As a result, some assurance can be given that our objectives can be achieved. It also says achievement of objectives. So final ERM is to have your objectives or the profits achieved. So probably this IRM framework came from ERM. ERM is for any type of company, and it's an international policy framework. Now I'm going back to IRM, which was because we are a financial institution. We manage our risk through an integrated risk management framework, and integrated risk management functions is to manage risk. So first we looked at the structure, now we are looking at the processes. How do we manage our, it says assess all type of risk through key risk indicators. Now another term has come here. You remember risk appetite, risk tolerance, risk mitigation. Now another term today we are going to introduce is key risk indicators. Now to give an example, I took that example of, giving a loan to a customer for 4 years, taking the source of funding from a fixed deposit of 2 years, and then we identified several risks. And the first risk we identified is default of customer, and we called it credit risk. Now, we just can't tell the board that we have a transaction as a result of we have a credit risk. We need to indicate that risk by some means or some indicator. Now, if a customer doesn't pay his obligations, we call it credit risk. Credit risk is indicated by, in your balance sheet, a classification of that particular advance as a non-performing loan. We call it NPL. So one of the indicators, I'm taking only one example here where credit risk is indication, is a non-performing advances ratio. Non-performing advances ratio is your total amount of bad debts or which are not being properly serviced and classified as non-performing. Those total divided by your total loans into 100 will give a ratio, which is we call it NPA ratio. So NPA ratio is one of the key risk indicator of credit risk. So IRM function, integrated risk management function, will start when we start various aspects of credit risk management. Moment you hit the one credit risk indicator is called NPA. There are other risk indicators. We are going to touch them when we do credit risk in detail. Then it also says review the effectiveness of management committees such as ALCO, ECRMC. ECRMC stands for Executive Credit Risk Management Committee. You can write down these abbreviations. ALCO stands for Assets and Liability Committee. Then ECRMC is Executive Risk Management Committee. Then we also have some banks we have put together the market and operations risk management together. So they call it Executive Market and Operation Risk Management Committee. Now, these committees are Chief Risk Officer will have a meeting with the business unit. So this type of committees will help the Chief Risk Officer to indicate to the business units. I told you business units are the key risk owners. You all are taking various type of risk. As a result, now we have developed certain key risk indicators like NPE. And these will be discussed at this particular committees in detail so that effective measures can be taken by the first line of defense, which is risk owners of our structure. Then he also says this IRM functions include recommend action against officers responsible for failure to identify risk. So there is some penal code here, because if you need to manage risk, then first you need to pass on all what various information what is required to business owner to carry out their risk. For that, you develop various types of policy documents or procedure manuals, and these procedure manuals are generally given to the business unit to follow. And if anyone go against with this procedure manual, will lead to various type of risk. For example, I'll take your board of directors will approve, say, okay, facilities to politically exposed persons, or in other words, we also briefly known them as PEPs, need board approval. Now, this is embodied in your policy documents of credit procedure manual. If you need to give a facility to a politically exposed person, it has to have a board approval. Just imagine your branch officer who has not studied this particular procedure method go and grant a facility to a politically exposed person, and later it get identified that this person defaults, and finally when you looked at the original applications, it has been approved not by the board of directors as specified by a branch manager. So the officer who are concerned, who violated a standard procedure, need to be sometimes held responsible or penalized so that in future this type of risk will not occur. So IRM functions also to identify such errors and failures and inform of possible corrective measures rather than penal measures. Corrective measures, we call them lessons learned, and lessons learned will give us a lot of information to carry out integrated risk management function. They also says initiate stress test to assess impact of various risk events. I told you IRM stand for identifying potential risk. Potential risk is that risk could happen into any of your portfolio. So if you knew that COVID is coming, we would have been very cautious about our lending. We would have selected the customers who have the best ability to repay, and only those selective customers would have enjoyed our facilities. But no one knew. Sometimes even the stress test would have been failed to identify this kind of a catastrophe. So stress tests have been done to actually forecast the future of various risk events that could affect the portfolio of a bank. So you need to initiate stress, and there's a special direction which had been recently issued how you should carry out stress test in a bank by the central bank. Then it also, IRM functions include define bank's risk appetite and risk tolerance limit. Now this is very important for you to get to know that two terms once again of risk management, particular term, risk appetite and risk tolerance. I'll take an example of this situation to identify what is risk appetite and what is risk tolerance. Now, we'll take a question to identify this. And that questions I will frame like this. What is your risk appetite for pawning? Now I'm looking at particular product which all the banks actually promote for various reasons. Now, pawning, come under different act. We call it Pawning Act. The Pawning Act says you undertake collateral by way of gold and you advance a customer certain amount of money. And this certain amount of money is repayable during its tenure on any given date or before a particular maturity date. And that maturity date will be 1 year. So that is what the Pawning Act says. So banks are not allowed to recall this facility and ask the customer to take your gold and give my money based on the Pawning Act. So therefore, until that 1 year, all the loans what you have given, all the facilities, the pawning tickets what you have executed are performing loans. We don't know whether the customer is bankrupt because we think we have a adequate collateral, and that collateral will stand good in case after 1 year if this customer thinks that customer defaults. So your risk appetite for this particular product is high because even in your capital computation, it is backed by a security called gold, and as a result, you have fully secured, and we call it zero risk rated facility. So pawning based on that assumption was promoted by banks very heavily, and therefore the risk appetite for pawning is very high in banks. And sometimes most of the banks have set up a small unit apart from your operations to give confidence to the customers to do their transaction in confidence, so other customers will not know that he's pawning his gold. So that type of leeway or the facilities being given for this particular product because it is, you don't need to allocate capital and it is considered risk free. But what happened in 2013? Banks, when your risk appetite is high, banks, and also in order to get this particular facility away from your competitors, you have various strategies. You do advertising, and you also advertise and say, we'll say during 2013, the gold prices based on international market for a 24 karat gold, the souring is which is 8 grams. Generally in international market, price is given in 1 ounce. 1 ounce is about 28 grams, and it is given in dollars. That time the 1 ounce is something like $1,200. So when you work back to a 8 gram souring, which we used as a denominator for valuation of gold, was something like 45,000 rupees or 50,000 rupees for a 24 and 45,000 rupees for a 22 karat souring. Banks had a high risk appetite. We want to take high risk, and this risk, just imagine you give a facility of 45,000 worth souring. Banks used to even give up to 40,000 advance for a 45,000 worth item, thinking that gold prices will go up. Therefore, at the end, if a customer doesn't pay, generally at that time, our pawning advances were carried 18% interest. So, if you give a 40,000 advance into 18% for 1 year, will give you something like 9,000 or 8,500. So, at the end, 1 souring of gold, you have given a capital of 40,000, you have accrued interest of 8,500, should have a value more than 48,500 because that is the amount you need to recover. Customers who in 2013, what happened was gold prices in the world market fell from 1,200 to something like $920. As a result, price of a gold sovereign was uh, equal to something like rupees 38,000. So your original advance of 40,000 is much higher than current market value. So the customers who thought rather than redeem their jewelry which is already been pawned, they went to the market and bought. And as a result, all the pawning advances became NPA because after 1 year there was no redemption. And you try to auction it, you will get less than your loan value, leave alone the interest. So auctions were failed to recover even the loan value. So as a result, banks were saddled with so much of gold, which total portfolio will not cover the security value of the gold. So as a result, banks suffered a loss. So risk appetite and risk tolerance is can apply to this. Bank has a high risk appetite for this particular product based on various assumptions which I told you. Some banks had a risk tolerance level. They mention uh, a limit. How we said you can give a facility of 40,000 to a sovereign which is valued at 45,000. So if you divide 40 by 45, which will give about 85%, 84% of loan to value ratio. That means you have given, you have 100 value, you have given already 84 and your interest rate is 18. So at the end, if you add 84 plus 18, it will reach more than 100. Still, bank was able thinking that the gold prices will go up. They had the tolerance level. We call it that limit, loan to value ratio, as the tolerance limit for pawning. Later, when they found this tolerance limit of 85 or 84, which is very risky, as a result, later on, banks started reducing this tolerance limit or the risk tolerance to something like 45. But when you do that, strategically you can't compete. Therefore, time to time, based on that, is change the tolerance limit. And when you change the tolerance limits, what happens is you are undertaking higher risk. And if gold prices in the market drops, you could experience a loss. So this is another example of risk appetite and risk tolerance. Risk appetite also can by way of a limit. Now say if your bank has an overall portfolio worth say 10 billion rupees, and if you bought things, our appetite is there for this particular product, will go up to 15 billion in the year, and that 15 billion is your risk appetite for gold. So it also can be recorded as a industry or the product limit, whereas risk tolerance is for individual transaction which bank undertake. Your tolerance limit is loan to value ratio. Generally now, because the gold prices are very good, now they have forgotten the history. What has happened in the past in 2013, banks still undertake very loan to value ratio. So the tolerance limits have increased. As a result, they could make more money. So these two functions, the two terms, I went on to give you further explanation. Then this IRM also should need to ensure various aspects. This framework should give officers who undertake risk a clear understanding. That's why I said they must understand three things. They must understand the policy laid down in respect to this particular transaction. If it is operations, how do you conduct? The process is given in the operational procedure manual. We also issue operational risk policy manual. So two manuals are there to manage your operation risk. Similarly, you will have a credit procedure manual, also credit risk manual. So there are various policy documents are given for officers to understand. Banks risk exposure within the limit established by the board of directors. Now, here we comes again. I told you that a particular bank, in my example, I said 10 billion portfolio pawning, and they have appetite to go further for 15 billion. So the risk exposure is, we should understand the overall limit of pawning is now 15. So time to time, when we reach the bank's portfolio, they will say, okay, we are reaching the portfolio exposure limits. Therefore, we should cut down our advances on that particular product. So banks' risk exposure is given by way of a limit. Now, central banks insist that all the banks should lend to agriculture sector at minimum of 10% of their total credit portfolio. So risk exposure of agriculture by virtue of the central bank regulation stands at 10% of the overall advances. They prefer to make it much more higher because we are an agricultural based country and we need to get self-sufficient in our food production so we could actually face any economic events which may hamper economic stability of the country. Then we also said this integrated risk management also should ensure risk-taking decisions are in line with business strategy and objective. This I discuss. Like if a business strategy is to have a new product development, the risk-taking department also, risk management also must get involved and inform what is the objective of the board in risk-taking decisions so that strategies can be formed accordingly. I go on to expected returns compensate for the risk taken. That means all the transactions we undertake should result in a surplus profit, and otherwise there's no point taking such risk. For example, when a customer requests for a facility and for you are sure you have a feeling that he is going to default, what we should do is we will decline that facility because it doesn't give us the expected return. Risk-taking decisions are explicit and clear. Now, say in banking, we say we have identified the risk, we measure the risk. Now, evaluation process of a credit facility is kind of a measuring technique. We also have various measuring techniques like, putting this customer's data into a computer and getting an internal rating, internal credit rating. Based on that, you can take a decision. So various measurements can be taken for a facility. I took examples which is on the credit side. So risk-taking decisions are explicit. So if you find when you do evaluation and you think despite the risk shown in this particular proposal that you can make money, what you do is you approve that facility. Explicit means you say, you don't say subject to this and all that. You say approved. But you also can introduce risk mitigation to that. You can insist on some kind of security. You can also insist on some kind of covenant. You can also state the price what you're going to charge on the facility. Those are actually risk mitigation methods. But what you do is you approve the facility That's what we call explicit and clear. Sufficient capital available is to support risk. That means equity of the bank, because they say one of the measurement of risk is the adequacy of capital in the bank, and we also says IRM also must ensure risk what you undertake need to have sufficient capital to manage that. That we are going to discuss in Basel II computations and capital management of a bank. So these things to be discussed in later subjects. So that document which I showed you in earlier is called Banking and Direction Number 7 2011. In this particular side, what I already mentioned, it has been summarized here. All licensed banks to adopt integrated risk management framework. Now, I also said what is framework. Framework include uh, policies, procedure, and structure. We also looked at the three different structure, and we will look at policies later on. Type of policies generally a bank need to develop, because those are regulatory requirements. And we also looked at various mechanisms or procedures. How do we manage risk? We also talked about risk appetite, and we also looked at various aspects of this IRM framework. And we said officers must be responsible, risk assessment has to be done in order that we may have, uh, even though there's a risk, there's objective can be achieved by way of profit. Then we also looked at how do we respond. I said in credit, we say we approved. Avoiding and accepting is the word in credit. So when credit facilities decline, what we say is we avoid that particular risk because it doesn't achieve our objective. Accepting risk means we still can make money despite having risk. So you can introduce certain mitigation techniques to get your objective right. Then we also said controlling activities. This IRM, we said that other two aspects are policies and procedure, which we will discuss in very detail in the coming slides. Information and communication flown down across up the entry, that means right across the bank. All this information should flow, and only the first line of defense, second line of defense, and even auditors will come to know. Monitoring also need to be done on ongoing basis. So now we looked at, I list out main risk policy documents what a generally licensed commercial bank should have. Uh, Central bank insists that integrated risk management policy framework is done. When this was issued in 2011, they gave 6 months for banks to have this particular document. So all the banks, I'm sure now, by now, have an integrated risk management policy framework, which is a very detailed document, which I will explain. Then also they insist that you should have a credit policy manual. And also this policy manual can be a describing your procedure or the credit risk. Then we also have market risk management policy, assets and liability management policy, treasury management policy, contingency and liquidity management policy, investment policy, operational risk management policy, business continuity plan. These are some of the areas which will come in your information security risk. Certain banks also will develop various other policies which may require to manage people. Whistleblowing policies, one of the such. Then your compliance department also will do their procedures under policy called compliance policy. Central bank also are insisting that banks should manage their operations. They should not allow money launderers to use our facilities to do their illegal activities. So most of the banks have this policy, also anti-money laundering policy. Then previously I talked about facilities given to politically exposed persons. So it can cover who are this policy can cover who are those people, politically exposed persons. Why do you need to treat them differently? Why do you need to actually take more care in doing transactions with them? So on will be described in this policy. Policy on related party transactions. Related party, I will explain who is a related party, mainly directors, associate companies, key management personnel. So when they undertake different type of transactions in our normal banking operations, they can influence the people who are processing. Therefore, related party transactions are subject to corporate governance, and violating directions will come under regulatory compliance. So these are type of policies generally bank would like to develop and review annually if there's a change, because certain standards or what you can get change based on various type of risk events which are discussed at the board integrated risk management frame committee. So every year it is suggested that review of these policies undertaken and also get approval from the board of directors on the latest version of your policy. I'm sure these are very important documents, because if there is a bank supervision visit to your risk management department, I'm sure with my experience, I'm telling you, first thing they will ask is, may I have a look at your policies? So you need to provide them all these documents, the latest versions, and it has to have board approved. Therefore, you have to have board approved minutes attached to it to show them that you have particularly reviewed this policy and you have got the consent of the board to carry on. Then I'm taking some of the policies and to identify why the importance of such policies. We take on the credit side. Credit side, we have a policy of most of the banks, they call it credit procedure manual, or some banks say credit risk policy. So you can name this as credit standard policy, standards and policy manual, or credit procedure manual. So fundamental standards of discipline is given in this particular document. It also describes various responsibilities of entire credit staff, starting from credit officer, going up to the board of directors. You give them their task. How do you identify? How do you measure? How do you approve facilities? And how do you monitor and review facilities? All lending activities as per this particular policy. CBSL on risk management system banks require typical credit policy to cover these standards. Standard presentation of credit proposal. So generally, when a customer requests a facility, if it is a retail nature, I would say like a credit card, from the applications itself, you can use that as a document on which you can approve the facility. But you know, banks also provide facilities to small and medium industries and to corporate customers. So therefore, their evaluation paper has to be submitted by way of appraisal form. So they say, central bank says this appraisal form must have some kind of standard, and this presentation of standards should be recorded in this particular policy. Then also it says rating standards and benchmarks. So most of the banks now have developed credit rating system or an internal credit rating system for your customers, which is similar to a Fitch rating, who are rating your bank and giving different type of ratings. So what you do is you get customer information, and this information will be fed into a computerized or manual process of the credit rating and arrive at certain marks. Those marks are, we call it standards and benchmarks. So if a customer who has get highest marks, say we'll say between 90 to 100, we give them a AAA rating of this customer. So this rating benchmarks has to be, how do you do rating, it has to be stated in this credit policy manual. Prudential limits on large credit and asset concentration. This I will touch when we go to credit risk proper, because central bank has a regulator also given a guideline. You should not give credit to one customer, one group of companies higher than a certain limit. When you do that, what happens is if this customer fails, you have a high NPA ratio, and that will affect the bank's profitability, and also bank will go into various other problems. So they say to your large credit, you need to have established certain limits. These limits, they say, total of your large facilities to customers generally should not exceed, the last top 10 borrowers should not exceed 55% of the total loans granted to others. So that sort of limits will be discussed when you do credit risk. Pricing of loans, risk monitoring and evaluation. So generally we know that now banks cannot charge, though the risk is high, they cannot charge high interest rates other than what is prescribed by central bank, because high risk facilities such as credit cards, pawning, they have set limits of maximum amount you can charge. So pricing of loans other than that should be done on the risk the bank undertake. Legal and regulatory compliances, we have subject on that. Delegation of credit sanctioning powers. Now, your board of directors should get a recommendation from credit risk management in collaboration with your business unit based on ability to lend by various officers in the bank. We should give them a delegated authority or a limit which they can lend. These limits can be described based on the type of facilities. Now, for example, we'll take a branch manager. Generally, branch managers are subject to, various requests from the customers. One of the major requests is a temporary overdraft. Temporary overdrafts may carry a high interest rate of 24%. However, if you allow your branch manager to give any amount he likes, what happens is that particular branch could run into huge credit risk. Therefore, it says, okay, temporary overdraft, the maximum amount the branch manager can approve is say 50,000. So you limit his delegated authority, or you provide him a delegated authority for a single transaction of overdraft up to 50%. But if he lends for a housing loan, against the collateral of a residential property, he could exercise a delegated authority of say 2 million. So based on the type of facility, this delegated authority will change based on the your management hierarchy. Also, it may get changed, or based on the credit officer's ability to lend, also it get changed. So we looked at credit policy in details. We'll see what other functions it provides. When you have a policy, this policy document will stand as a gatekeeper. That means it will not allow you to deviate from the policy documents and get into high risk situation. This policy document, if says you need to get approval for politically exposed persons loans, it will stand as a gatekeeper. Look, I know this guy is good, but you know your policy says you need to have the board approval, so you write the proposal and send for board approval. So it functions as a gatekeeper. Define trust areas in relation to credit culture, profit objectives, and regulatory directions. So this is a basic tool which will develop a culture for a bank. Certain banks have a credit culture which says they are very cautious. They like to evaluate very thoroughly a proposal, and moment if they identify risk, they like to have collateral. So the customers might say this bank is very strict in credit. So this type of a credit culture will help the bank to manage the credit risk well. So some banks look for growth. Though their credit culture, when you want for growth, what will happen is they will be very lenient on credit. They want to give as much as facility and grow the books. And while growing, they are looking at the profit objective. And as a result, sometimes they can get into trouble. Some banks also looked into the regulatory directions very well. So actually, now if the central bank says nowadays you should not allow LCs to import motor vehicles because of current situation, banks need to follow that. So in your policy document, it says regulatory directions on different type of facilities should be mentioned in this. So if there is a requirement to take a margin or restriction of LCs to a certain importation, your policy document should state that. Define acceptable level of risk. We looked at this in our risk appetite and risk tolerance, so I'm not going to say. Prevent risk concentration. Risk concentration means we are going to touch that, and I call this concentration. I can give another word of credit or very colloquial word where we use. Don't put all your eggs in one basket. That means, say you have a branch in one particular location, which you know the construction boom has taken place. So all the facilities what you get to provide are related to construction industry. What happens if a construction industry come to a recession or certain customers fail, unable to sell their properties on a property market comes down? So if you have concentrated all your lending to that particular industry, it is similar to what you have put all eggs in one basket. Moment you topple this basket, all the eggs are going to get break. Similarly, if you have lent only to construction industry and if that particular industry fails, in your loan book, you have a high non-performing ratio. Therefore, these documents also must provide diversification. That means you must have a portfolio, your exposures to different type of products, different type of industries. Therefore, just because one industry fails, you are not get that much affected. Otherwise, what will happen is if you have concentration on one particular industry, and if that particular industry fails, you will, I can say that you can have 100% NPA in your loan book. It provides pricing strategies through use of credit risk rating framework. This we will discuss when we come price as a mitigator of credit risk. Definitely a price stands as a mitigator because if the risk is high, generally banks charge more. That's why you charge high interest rate for your credit cards. So we move on to our next slide. This time we are talking about a different type of a policy, which is market and liquidity management policy. This is also a very important document. Generally, we divide treasury into three parts. We say front office, the actual treasury which deals with the other banks, with the money market. They buy and sell bonds, treasury bills, they buy foreign exchange, deal in various other market instruments like stocks. So they do the transaction upfront. Then you have a middle office, which is come under the risk management department. And all the transactions what you undertake should display in a screen in this middle office for them to identify, to see these transactions are based on the policy laid down policies. Are those transactions based on current market rates? Have the treasury front office taken high risk in order to make profit? Also could be done from this middle office. Every transaction need to make a settlement. Now say if we buy from another bank a bond, dealers will do the deal through, but you know that bond has to be, the transaction has to be completed by payment to the other bank or to the central bank. So this has to be done by the back office. So treasury will have treasury front office, treasury middle office, and treasury back office. Based on these three officers, they see that you manage the market risk to a great extent. And also, the finance department also will get involved in liquidity management because they also carry out various assets and liability sensitivities and maturities. Based on that, they will identify the liquidity position of the bank, and they are the people who actually ensure that statutory liquid ratios are maintained at all times. So this policy will talk about what I just said now. Then I just spoke about assets and liability to enhance profit, to increase capital through analysis of banks' financial results, analysis of banks' liquidity positions, and reports of various risk and outlook of interest rates in the economy. Now we have spoken about almost 2 hours, so I thought it's time. In another 10 minutes, we'll take a break. Assets and liability committees are one of the very important board subcommittee. Now you remember in our previous discussion, I talked about one of the major board subcommittees, BIRMC, that is Integrated Risk Management, covered under Board Integrated Risk Management Committee. So remember that particular abbreviation BIRMC is a subcommittee of um, risk management. Similarly, there is another board managed subcommittee called ALCO. Now, assets and liability management, ALCO also need to, provide financial resource of the bank. What is your liquid asset ratio compared to the regulator's requirement? It also gives various risks relating to liquidity.
Excuse me. So I have another question.
Yeah, sure.
Uh, what's the meaning of ECRMC?
Yeah, I told you before you get into the board subcommittees, various banks have another committee in between your chief risk officer and the board. These particular committees are called executive committees, and these executive committees are ECRMC stand for Executive Credit Risk Management Committee. Now, in this committee, your CEO will participate along with your chief risk officer. CEO will represent your business line, that is the first line of defense, and your risk management is the second line of defense. So, before you put various items for the discussion at the BIRMC, generally most of the banks, the executives will discuss because they don't want to take minor matters to the board. So certain small type of risk which involve the business line, which could be corrected at the decision making at the executive committees. So those executive committees are made for credit risk, you can make for operational risk, you can make for market risk. So banks will have 3 executive committees sometimes to manage the risk between the business line and the risk management line. So ERMC stands for Executive Credit Risk Management Committee. I hope my answer will help you to understand that abbreviation.
Yes, sir. Thank you.
Okay. So now we'll move on to our next slide. It is called stress testing policy. Now, this I need to devote a lot of time because which is a very important area under the present context. Now, say stress testing is done to identify future potential risk to a bank. It can be potential risk can come from various categories of risk. It could be a credit risk in the future. It can be a market risk. It could be operational risk, which could happen. Now, regulator has given a lot of prominence for this particular area, but this is also mentioned in your integrated risk management policy. If we go into that particular document which I shared with you, page number 248 up to about 257 is called our IRM risk management framework. In that, you have a passage for stress testing. In that also, they have basically indicated how do you do stress testing for future potential risk. But they found, despite stating there, most of the banks have not covered potential risk. As a result, they have faced a different type of risk. For example, I would say now we would like to minimize our operational cost, especially in the time of when you have a pandemic situation of COVID-19, you need to operate. So we allow some of the staff to work from home. And work from home means you give access to the bank's data warehouse to their personal computer for them to process transactions. What happens? This could be element of risk. Staff member can be a fraudulent, he can do fraudulent activities. These are all called internet-based risk. We also allow our customers, those who are in the line of, they never had internet banking facility, but situation demands that we need to provide this facility to people who know how to use it or who doesn't even know how to use it. So, promote this particular aspects of banking to everybody so that, you don't need to bring people to process their transaction in a bank. You don't need to bring customers to the bank so that your potential security of health risk can be covered through online banking. But online banking on the other side will get subject to various information risk. So stress testing is to identify these potential risks. So when we include a new product or when we go into a situation of our country might go into a situation of recession because we had a lockdown situation of 2 months. Economic activities came to a standstill. What happened is, as a result, customers who borrowed money may not generate enough income to repay their banking obligations, so they can default. So, as a result, we need to now test whether if this particular situation continues, and also on the other hand, if economy is going into recession, people doesn't produce, people doesn't consume, and everything will come to a standstill, and money circulation will stop. Banks loans will not get repaid. Your asset quality will deteriorate, and as a result, you will get into various type of risk in the bank. And I think the regulator understands this, and also this situation will lead to various social problems. And as a result, now I can see within a matter of 2 months, interest rates were reduced by the central bank by about 1.5%. Now, reduction of interest rate means the bonds which have been issued at high interest rates, if a bank we are holding, they can make huge profits by the treasury. So your stress testing sometimes may result in not only the risk, you also can test to advantage to make higher profit. So stress testing, if you think that further reduction of interest rate will take place, banks will invest more money on government securities at current prices. So they can make more money, rather than lending to customers and taking credit risk. This sort of situations will arise, and therefore you need to have a policy. How do you see the future of various risks that could affect various type of risk bank undertakes, and as a result, what will be your profitability if that impact happens? What will be your profitability? What will happen to your liquidity? What may result in your capital adequacy is the ultimate result of this particular stress testing. So it's a technique we generally adapt. We call it sometimes sensitivity analysis, scenario analysis, enterprise risk testing, or reverse stress testing. These are the techniques what we used in this particular testing, and then you put all these scenarios and testing methods into a policy document, and that policy we call it stress testing policy. So generally, once the policy has been established, bank need to carry out periodic stress test, and those results you need to escalate to your board integrated risk management committee and for board of directors to take various decisions. Sometimes scrap various products, introduce your stress appetite high or low in various industries. Those will take place based on your stress testing policy. I intend to cover this particular aspect in a future sessions, because Now central bank has given a guideline or different scenarios or how to carry out this sensitivity analysis in a very descriptive manner in a direction. So based on that direction, I will have a further session on this particular subject matter. Another policy is called operational risk management policy. Now, this is also a very important document because I told you that we are now deviating from our normal. The term actually used for branch banking is called brick and mortar operation. That means those days we had one delivery channel of performing our transaction with clientele. That is, a client comes to a branch. Branch is made of bricks and mortar is cement. So we call a branch a brick and mortar, and any operations which is carried out in that particular branch is called brick and mortar operation. But now that has been changed, and change will take place to highest level with various situations the economy confronted with. COVID-19 is such a situation. So we would like customers to come to the branch because main reason is it's a health hazard, and to have social distancing, you need to provide sanitation, you need to safeguard your staff members from anyone. So you need to have a customer who have a person who is checking their temperatures before they enter, make sure that they wash their hands proper. All those operations could be minimized by way of introducing internet banking and phone banking and usage of ATM. So when you have these other type of delivery channels, what happens is they are subject to various operation losses. You can have your ATM machines not only in your branch, but you can have in offset areas where you can have it in hotels, you can have it in hospitals, you can have it in marketplaces. But then what happens? You need to feed cash into this on a very periodic basis. How do you feed cash? It has to be transported. When you transport cash, there's a risk of burglary or theft. You need to provide security. Those are all additional expenses. So your operation risk policy should cover various type of delivery channels generally banks offer. And you also must identify various lapses or the system failures, failure of people in executing transactions, or various events, burglary, thunder, lightning that may occur will damage various assets in this particular policy. So this also need to be a very extensive policy, which also should give you not only the type of events that will take place in operations, but also should give a process how do you manage. One of the process you minimize or mitigate risk is a method called risk transfer, especially in operation risk. If you can't identify or measure the amount of loss you are going to make, best thing is to transfer that risk. How do you transfer it? You can take an insurance policy against that particular method. Now say I told you about cash transportation or taking your cash from your head office to a ATM. During that time, you are exposed to theft. This could be covered under cash in transit policy of insurance. So these things are recorded in this operation risk management policy. The method of operations and the risk involved and the risk mitigation methods are recorded in this operation risk management policy. So I think these are the type of policies which we get in banks. So with this, we complete actually what is integrated risk management. Uh, so I would like to, for you to, I would like to take a break now, and also you may come up with, using chat. Uh, so far, what we have covered, anything you didn't understand proper, you can ask questions. So after the break, what I do is I intend to first answer those questions so that we will have a better knowledge of what I have been speaking, because finally the results, what I want to have result is that you understood in proper all what I have said so far, including this particular what I did. I couldn't actually take only the risk related. So I downloaded the entire document, all directions what the bank has issued, what the central bank has issued prior to 2013 is recorded in one document, so which is being shared with you. And in that, risk management items are many, but majorly is the integrated risk management policy, which runs from page number 248 onwards. So take that as a guideline in our future discussions. And I would like you to, at least read through once. And if you don't understand anything, because remember, major item in this framework is three items, which is policy, procedure, and structure. Structure, I have given you a nice structure, which is a generally a well accepted structure of any bank. Any licensed commercial bank would like to have 3 lines of defense, and I have recorded that in between, I think so. Also, you questioned that in between that, what is executive committees, which I explained. So that structure really works for risk management. And the procedures will be discussed in greater detail when we take next item, which is credit risk. So while describing the credit risk, we are going to actually look at the entire process of risk management pertaining to credit risk in that particular module. So our next session is on the credit risk management. Credit risk management is the largest risk in a bank, because if you take a balance sheet, that is the highest risk a bank generally accepts, because mainly if you take your balance sheet includes your current assets and fixed assets. And the current assets, generally about 70% include loans and advances. So from total assets, 70% include the money what you have given to your customers, and that is subject to credit risk. So if you want to take 70% go bad, means I can expect the highest level of risk in your bank. So management of credit is a very important area, which I will do after the break, after answering your queries on chat. And now we'll take a break. Thank you very much, and stay on. We'll meet in half an hour. Based on loans and advances. You can interrupt me at any time by just switching on your mic and calling me. Then I could answer any queries, because I went through the chat section and find out there was nobody has sent me any queries, but you're free to talk to me while I'm doing this presentation. So Credit risk is very critical because it affects the asset quality of the bank, and generally is described into two areas. One is we call it counterparty risk. That means it's related to your customers. The counterpart is the clientele who borrow money. Uh, then he defaults due to various reasons, and as a result, you will have NPA positions. Then the other type of risk is we call concentration risk, which that risk is assumed risk by the bank because you start lending to one sector or one region, one product, and you concentrate all your disbursements into one particular industry or one particular product. If there's a failure on that industry, you're going to have severe concentration, and that concentration may lead to a huge credit risk. So counterparty risk, we say, look before you leap. That means counterparty risk can be managed through various ways. The first way we said, on your structure, I said the first line of defense is your business unit. And that business unit can, to a great extent, arrest the counterparty risk by proper evaluation. So risks relating to credit is the counterparty risk is the customer's creditworthiness need to be identified first. So that we generally do through a proper evaluation, and that evaluation can be either financial evaluation, we call it a quantitative evaluation, or you looked at the other aspects of the client, we call it qualitative evaluation. You put these two evaluation together, you can arrive at customers' creditworthiness. So counterparty risk can be identified through evaluation. So identification is mainly done through evaluation, but there are other methods we use based on type of counterparty or type of industry to whom which we lend. There are various other methods we follow. For instance, if you give retail credit is like credit card facilities. You can use various other measurements like to arrive at the counterparty loss. You can use various measurements like credit rating, or we call it credit scores. So those scores will give you an indication of how risky is your clientele. So it's a identification plus measurement method which we follow. So on this slide, counterparty risk is just what you need to understand is you need to do a proper evaluation. Evaluation include financial as well as its qualitative aspects. So to make good credit decisions, you need to understand customers' business well. So then obtain all the information what you could get from the customer. And when you say codify policies, means you apply the bank's credit policy into his business line and see whether he is in line with bank's policy and is a eligible customer under the bank policies to lend. Your strategy says, okay, undertake this particular industry, and if this customer belongs to that industry, especially banks would like to lend to exporters. They could earn foreign exchange. Plus, there are various other fee income associated with such facilities. So, if a customer of that nature comes, you would like to give credit. Then you can apply various models. I mentioned about credit scoring model. It's actually a type of marks you given for various questions you ask from the customer. Then you aggregate those marks and arrive at a score. And if that score is well above a benchmark, then you grant this credit to make a good credit decision. So finally, most of these credit decisions come from experience and judgment of the frontline credit analyst. So to do well on this part, you need to be attractive to customers. That means you must have good speed of approving facilities, use right channels. That means you have to request customer to put into a type of model and see his credit worthiness. Also, you also can apply risk-based pricing to get the maximum results out of this customer. So we are going to go into more details of how you do it, what you do in the business line, as well as what you do in the credit risk management side as far as counterparty risk. Then the concentration risk is, they say, do not put all eggs in one basket. That means you need to diversify your portfolios. That means you should not lend to one particular industry or select one product and capitalize on that and lend. And if something goes wrong on that product or the industry, you will have huge exposures. Those exposures are become non-performing, and then you will suffer huge credit risk. So they say you need to manage portfolios, transfer high risk portfolios through various kind of measures called hedging. So we are going to first initially touch mainly on the counterparty risk. Now counterparty risk is the default risk. So before going through counterparty risk, I would like you to understand this particular process. We call it a credit process. Credit process as per guidelines issued under the direction 2011 direction number 7. The credit risk management, they also recommend that you need to have dual approval. Dual approval means at least high value loans should go through the business unit and get approval, but at the same time bank has a risk management department. In that you have a credit risk management unit. They also need to recommend or approve jointly this particular facility. So two eyes will look at the customer's credibility or creditworthiness in approving this facility. Especially the risk factors of the customer will be further evaluated at the credit risk management, so we can take a comprehensive decision. So this process need to be studied very well in order to identify the credit risk. Now I have put customer here. Your customer generally will call on the bank and meet somebody in the credit department. What if this process change? Somebody in the credit department received this customer and identified him as to be a potential customer of a bank. That means if someone from the bank goes to the customer, that means you may have done your preliminary studies about the customer. He may be a reputed businessman in the community, and there are various reports you have received or business information about this customer who is doing well, and his market information and reputations are high. So we generally nowadays we call it business development. Business development is bank is going to the customer. So if you can go and get a customer whose creditworthiness is been established or reputation is very high, I think that's another way of identifying a low risk borrowing client. So then you don't have to very strictly follow all the rest of the processes, because you got a customer whose reputation is good in the market. If not, the customer will come and he will ask for a facility. We call this a process called loan origination. This process is also very important here. To originate a loan, you need to have information. So at this moment, you need to know customers' business well, and you need to ask right questions. That means in order to evaluate the next step, you need to have information. Now, I'll take a small example of corporate client. What do you ask from this client if you ask for a facility? Corporate clients generally have audited statements. So generally, if you are in credit department, the first thing with regard to finances, what you ask is, can we have 3 years of audited financial statements? Now, you will be very happy that you could do a financial analysis of this customer. But this auditor statement, on one hand, you need to understand that these are historical figures. Probably by the time you get this information, they are maybe 6 months to 1 year old. And as a result, during that time, customer's position or his creditworthiness could be changed. Because if you are a good risk manager, you need to understand risk we can change overnight due to various economic factors. Now, customers who had a very good creditworthiness before March, now you have a situation of COVID-19. Their situation may be different now because their creditworthiness have affected due to a environmental factor which has affected entire nation. So therefore, if you are doing financials, you need to have most current financials. So apart from 3 years audit, you should be asking some other documents we call management accounts. Management accounts generally companies prepare either monthly or quarterly, at least quarterly, so that at least you know that they are just 3 months old. So apart from that, you can ask various other subsidiaries like your creditors statement, your stock statement, so on. So you could analyze his finances proper. Then here I have listed two analyses. One is called financial analysis, and other one is qualitative analysis. Financial or quantitative analysis can be done from your statements, financial statements, what you have got. But the customer's qualitative analysis means which cannot be given in figures, is market reputation. You cannot give a rupee worthness to that. You cannot see his quality of products. That you cannot actually value from money. You need to get a comment. So those items where which cannot be given in financial terms but helpful in evaluation process of identifying the customer's risks, you need to do a qualitative analysis also, which you need to do from some other documents. Mostly if you take a company customer, you need to be asking his company profile. What is your product range? Who are your buyers? Are you an importer? Are you an exporter? What kind of organization structure you have? Do you have correct people to manufacture or trade your product? What are your marketing arrangements? What are your credit terms to your customers? What is your stock turnover? What is your debtors turnover? All that you could be asking based on your qualitative aspects of the customer, because a policy of giving credit to his customers will be a policy document, that is their credit terms will be probably sometimes will have it in the customer's company profile. So those things are important for you to, if you are going to even analyze your data statement, you could compare that, the company's policy versus results. So credit origination requires gathering of information. So this you need to do it in a very thorough manner in order to do the credit evaluation. So once you get credit evaluation stage, you do a financial analysis. I'm sure in this particular course, you may have done already the financial analysis for customer income and evaluations and various other things. So using those results and the qualitative aspects like, crib report, various status reports you run, and market information, you do a paper we call credit appraisal form. Now this credit appraisal form will give you a recommendation by the analyst whether to give facilities. He would have discussed with the client his requirement, and he would have to analyze all the credit risk, whether he is satisfied, and sometimes he will propose here certain securities and request that customer whether he could provide that, and this he'll prepare paper. So even our integrated risk management framework, they say every credit must have a paper which is a standard format. So most of the banks have a standard format of credit appraisal form. Once you do that, here I have put arrow here. What you do is you pass a copy of that to the risk management department for credit risk assessment, further assessment. Your evaluation also assessment. So up to this level, what you're doing is 2 items in the risk management process. Taking all this information, you do a risk identification. So you analyzing those, we'll do a measurement of his credit risk. And if that measurement, you're happy and you can make your objectives, like you can make a credit profit out of this customer, you go to the next stage of credit approval. I also have put execution here because sometimes your approval will be not only just approve, but approval will be subject to taking of certain collateral and executing documents, guarantees, and sometimes also you will insist a certain covenants. I will explain to you what is covenant when you go through. So your approval will be based on those. Now, I told you one copy of this appraisal form get passed to credit assessment by the credit risk department. Now, credit risk department see to particular industry this belongs to. Now, say if your proposal is to build a hotel, this particular facility, they will look at the portfolio of hotel industry or the tourism industry and say, if we approve this facility, the portfolio value will go up in this particular industry. Then they will check what is your risk appetite for that particular industry. You remember the word, the term which I use, that means overall industry limit will be the bank's risk appetite for that particular industry. So that overall limit will be established by the board with the recommendation of credit department. So we will put this particular amount into the same portfolio and see whether it exceeds total limit, the total limit of risk appetite of the bank. If that exceeds, risk department will write and say, okay, we are already exposed to this particular industry that to the maximum risk limit, therefore we cannot accommodate any more facilities. So portfolio analysis also will give, and if it is acceptable, if it is on the same tourism industry, you have wealth of knowledge here from that portfolio, what kind of questions earlier you have asked from that customers and what difficulties they have faced. So you will check in this paper whether those risks have been properly addressed. So while portfolio analysis, you also looked at the industry and you benchmark the new client, his creditworthiness against the highest level. Unfortunately, in Sri Lanka, we don't have industry benchmarks. Now say, why I say industry benchmarks are like this. Now say you take customer from tourism. If tourism, the best customer of yours or the best customer industry is making a net profit of 10%, that is the benchmark. And you see from the financial analysis of your customer, how far he has been close to that 10. If you got 5% net profit, that means he's not the best. So you cannot put him in the same portfolio in this your credit assessment like the best customer in your portfolio. So you take more care when approving facility. Then I also have another method called credit capital. This credit capital need calculations because now banks, what we do is we take our total assets and we assign a risk weight to each asset. Now you remember when I said your Pgedbm portfolio. Pgedbm portfolio is backed by gold. Therefore, we said any exposures to Pgedbm portfolio is zero rated. Similarly, if you are given against your own fixed deposits, you have given against the customer's own money. Then also it is zero rated because it's as good as cash. If you are given facilities against treasury bills, again, what happens is those are prime securities which you can encash at any time, or the government guarantees. Those also we consider zero rated. So you don't need to allocate capital for those type of facilities. But any other facility other than what I have mentioned, there are zero rated facilities, you need to allocate capital. Allocate capital means capital is equity. And generally capital adequacy is that from all these risk weightages what you assign to different type of lending, total of that, you divide your equity by the total risk weightages, you must have at least 10% equity under the Basel II. But with the introduction of Basel III, now this percentage has gone up to 14%. So if I am to go back and explain this further, I may need to draw your attention to I hope you could see the board. I will erase this and we do a small exercise. Customers' risk weight is generally given by a credit rating. So generally, if you give, similarly customers are credit rated. Now credit raters are the best customers will have AAA. And any facility given to these AAA customers, risk weight is 20%. You take a customer, now you get AA customers, single A, you get. This is a credit rating which I will explain to you in details. You get a customer of BBB, we say he carries 100% risk weight. So now you have two customers. One is AAA. You ask for a facility of 10 million. This guy also asked for a facility of 10 million. And this one, he says, I will not provide you any collateral. I need this amount on clean basis, and also he says, I will pay you only 10% interest. Now this guy, he gave us a collateral of 20 million worth property. And he doesn't demand interest, so it is a sheet rate of 12% applies to him. My question is, when you have a situation of these two, which customer you prefer to lend? We call it AAA customer is number one, BB customer is number two. So you note down what is in the board, and we have a small discussion on this. To do that, I'm going back to the presentation. We are talking about credit capital. So on this subject, I gave you an example. You have two customers. One is a AAA customer. His risk weight is 20%. So I will explain to you now. You have to do in your paperwork from there rather than going back to the screen again. When you say 20%, he's asking 10 million rupees. 20% of 10 million is 2 million. Whereas BBB customer 100%, 10% of 10% of 10 million is 1 million. Not 10%, 100% is 10 million itself. So risk weights are, number one customer has a risk weight of 2 million. Number two customer has a risk weight of 10 million. Now capital adequacy, we looked at 10% before we looked at the enhanced capital now required under Basel III. We look at Basel II capital. Banks need to provide 10% of risk weight. So 10% of number one customer whose risk weight is 2 million is 10% of that is 200,000. Whereas number two customer, 10% of 10 million is 1 million. So from your equity, you need to allocate only 200,000 for the number one customer and 1 million for the number two customer. Though he is given properties as security, banks capital erosion will take because you need to provide that, and credit risk is measured under Basel II based on risk weight of assets. So certain banks who are actually finding it difficult to maintain capital adequacy, and if they have to allocate for their credit risk certain amount, they might select a AAA customer whose 20% allocation is worthwhile, though it is on clean basis. Whereas banks who has adequate capital, they might accommodate both, because generally the default rate on AAA customers are low. So they would like to have a quality portfolio, and they might accommodate him on clean basis. At the same time, since capital is sufficiently there, they also can accommodate number two. So you understand what is credit capital is. I'll explain to you further when you go down to Basel II. Then also they looked at the appraisal form on the credit risk department, whether these appraisal forms, all the things which have been mentioned in the appraisal form, will adhere to the credit policy manual. Sometimes, your business unit will not remember all the terms and conditions what is listed in the credit policy manual. I told you in the IRM framework, three things required. One is policy, the procedure, and structure. So we need to verify this particular proposal is based on correct procedure and policy. If these three things are right and the evaluation already been done by the credit evaluation unit also to the satisfaction of credit risk department, they will approve this facility and the paper will be sent back. So generally central bank insists dual approval or joint approval, then the credit get approved. Once the credit get approved, if approval has certain conditions based on risk, like execution of securities, those will be done by your credit administration department. Once those are completed, you disburse the facility. Once it is disbursed, you don't stop your credit management. You need to review these facilities time to time based on repayment or on an annual date of review and to do monitor. Similarly, our document for integrated risk management direction number 7 of 2011 also indicate credit risk department should not stop after approving. They must also look at least 35% of facilities which have been approved to be reviewed annually. So dual renewal will be done. At least the large facilities will be reviewed by the credit risk department. So this process is a very important process. It is simple coin, two sides of the simple coin. One side you manage credit by the business unit, the other side you manage the risk by the credit risk department. If this process is done proper, I think you have done your identification and measurement right, and also you have responded right, and thereafter your monitoring and reporting will take place automatically. So this credit process is important. This process is the credit risk management process, the proper credit risk management process. The dual control of banks' credit risk is being taken over by the business unit. We call it the first line of defense or the business owners, then also overlooked by credit risk department to arrive at our objective of approving proper credit so that we will reach our objective of profits. Now, having done the identification part and how we measure, you need to also to understand the risk factors. I told you we need to understand potential risk of credit. Now, then the lessons learned will help you to make your decisions. So, what make a customer, a counterparty fail to meet their financial obligation, or in other words, why a customers will default? I have put them into different categories. I have put into two categories of people or your customers who are individuals and businesses. Individuals generally, when they default, they are unemployed, so their income. Some individuals are willful defaulters, so you got to identify them and then be not to grant facilities to that type of clientele who are blacklisted earlier. Then rising cost of interest rates and rising cost of living will hamper the amount of money which is being saved to repay your installment loans. Death, illness, medical bills will escalate. Is inability or inability to pay. If you have given money to share trading, if share prices drop and you have capital losses, then what happens is then there's a chance that you will probably default that facility. Loss of assets without insurance cover. You run a business, you don't insure for fire and burglary. If either of that happen, you don't get compensated. Then banks which fund that total operation of business, it doesn't have a backup. The fire comes, customer lost his assets, bank will lose the funding what he had done. So these are the types of individuals why they default. Businesses mainly their cash flow. If a customer doesn't get cash flows due to poor sales or extra competition from his competitions, if sales drop, his cash flow will drop. If cash flow drops, his repayment capacity will affect. So main thing is you won't always give business loans to a running company. That means if a customer who's not selling or generating income, I think you should not touch. Changes to prices, regulation, and technology. Some companies may have to close down due to high price in raw materials what they buy, or government regulations will come, their operations get hampered, or new technologies will come, newcomers will operate under very low cost and certain customers will not be able to compete with them. So businesses can collapse. Loss of key customers and suppliers also a result of businesses to collapse, or the suppliers or employees. Most companies sometimes mismanage their cost or the liquidity. As a result, they go into non-performing. Lawsuits, disputes, fraud, and strategic default also part of reasons for default. So you need to understand when you identify. That's why we do certain cribs. We will see whether he has been previously listed or blacklisted. So those things we could identify. We can get his indebtedness to other financial institution by running. So evaluation of a customer is necessary also to predict certain things, the risk what he undertake before we commit our facilities. I have put more reasons for NPL, especially on the part of the bank. If it doesn't have poor controls and if you make mistakes in documentation and the credit culture is loose, you also run into credit concentrations, and as a result, so your reliance on collateral lending without looking at the cash flow, one day you may become a land bank. So sometimes customers, the bankers think if he can take a property as collateral, instead of looking at his finances and seeing that he has a good cash flow and profits, might lend against the collateral, and later you find that you have only a collateral which require a lot of administrative work to realize, go to courts, file actions, acquire that, tell the fiscal to chase the customer out of it, auction it. All those processes are costly things, realizing collateral. So rely on collateral also area where bank could have credit risk. More liberalized lending practices and unrealistic valuations, which is I discussed earlier. Pro-cyclical credit. Sometimes we have situations when our deposit bases are very high, you have no place to park your money. Either you keep in your cash form or you buy government securities, which sometimes carry even lower than the interest rate than the fixed deposit interest rate what you have paid to the client. By lending and with high earning generating products only you can make money. So during that time you will have a very liberal policy on lending. So you select customers who are not credit worthy, but you provide facilities. Those things will boomerang on the bank and running into credit risk. Lending to low-income borrowers and risky borrowers, considerable lapses in security documentation, which I discussed. So you need to take care of various aspects when you're lending. Now, I'm going to go further in description of evaluation process. Evaluation, you remember I told you, it's identification of credit risk. Now, you can have this identification by various methods. And these various methods can be used for various type of credit. I originally classify your customers into individual and businesses. Now I'm classifying your credit facilities into 3 categories. The first category is retail credit. Retail credit are generally you grant to individuals, and products like credit cards, housing loans, personal loans, those are actually retail credit, and these amounts are not very big, and or which are not backed by heavy security also. So these retail credit need to have a very speedy way of evaluation. You can't ask for customers' finances, you can't ask him to audit his finances, they will not provide. By way of customer interaction, you identify his creditworthiness. Sometimes this will be very cumbersome. Therefore, what they do is they follow a method called credit scoring method. Now, for instance, look, if I want a credit card from your bank, I come there, they give me the form. The form will have at least 25 questions. Depending on the answer which I provide for these questions, you do a credit scoring. For instance, of course, you will ask my name. Name, you will not provide me any scoring. You ask my what is your employment. Then I will say I'm so and so, holding executive position in the company, a permanent job. My position is this. Probably based on that, you will categorize the customers into executive, middle management, and minor workers, and provide a score. If I have put a executive or the corporate management, you might probably give me 100 out of 100 in that particular section. So now I have scored in that section 100. I'll go to the next question. Like, you will ask my address. Address or the contact. I'll give my postal address, I'll give my email address, then I'll give my fixed line telephone of the residence, then I'll give my mobile phone, and also I give my office phone. That means I have provided you all the details where you can contact me at all times. There again I score 100. But if I fail to provide my office telephone number, that means during my working hours, bank is unable to contact me. You will deduct certain points from that. Similarly, if I don't give a permanent address, you can deduct. If I don't have fixed telephone line, only give a mobile line, which can be disconnected at any time. Therefore, I will get a lesser marks. So all these questions will add up a mark, and you total up those marks, and we'll say I got 55 out of 100. But your bank has given you a benchmark. We say any customer scoring more than 60 marks are eligible for that particular credit facility. So you aggregate my points and you come up with 55. and you will tell me, sorry sir, we have to decline your request. If I have taken a score of about 75, I'll get a different answer. So thank you for applying for this facility. It has been approved, and you can have a credit limit of say 100,000 on a silver card or gold card or whatever the types they say. So that mechanism is called credit scoring. So generally, virtually all personal loans, mortgages, credit card applications are arbitrated by scoring system. So this is very easy. You can decide on a customer very fast, and it's a kind of a mechanical thing. You just put the marks and aggregate, and if you pass that test, it's like this Z score. You have higher Z score, you will enter the university. So similarly, you have a higher score above benchmark, you are eligible to get this facility. However, in the good olden days, even some bankers even now also follow in retail credit evaluation, they follow a method called 5 C's of good credit. Now, this is not easy as credit scoring, but a lot of seasoned bankers think this traditional method is more less riskier, and it will give better results of evaluating the credit worthiness of the customer. Now I will also put why I think you know all this. Sometimes if you have done this, 5 C's of good credit on a retail customer is to look at his character. Now, first C is the character. If you have dealt with this customer earlier and his track record is good, that is what the character you look for here. You are not going to ask character certificate from a ground sevak or somebody about your customer. But you need to look at this, even if you run through a crib report and you see all the facilities are in regular basis being repaid, then his character is generally, we assume, that he can be trustworthy and his integrity is good. Capacity. If I am employment, you will ask my pay sheet. No? My pay sheet is being asked is to check my capacity, whether I have the repayment required to make my financial obligations right, or check my cash flows. So second C is to check whether I have regular income so that I can service the facility. Third one is capital. Capital means now in most of the cases, borrows equity. Now in a project finance, you will ask how much contribution you make. But when you ask for a credit line on a retail basis, you don't ask that question because total amount you request is the total loan amount what you get, and there's no borrower contribution. However, in your questions, we'll say in your credit card questions, they might ask your residence. Is it mortgage or freehold land? If it is in your name and if it is freehold land, that you have a certain amount of asset. So the capital is that. Similarly, they say you have a vehicle and they will ask whether there is a lease. And if there's no lease, that means you are a freehold to a motor vehicle which has some value. So capital is borrower's net worth, which will help the customer to not to default. So because he has certain amount of money or savings there to meet the facility. So third item is to check all that. Conditions is you ask for the purpose, what do you want this money? Unfortunately, nowadays, most of the retail facilities, you don't ask, they say personal requirement, especially personal loans. You can even take a personal loan stating that it is a personal requirement, and sometimes customers use that money to pay a past due debt of another institution or outside borrowing. So sometimes these conditions cannot be established thoroughly. Collateral. So banks generally on a facilities of retail do not insist on collateral, but they can have some covenants. Transfer salary to the bank. So you take the undertaking of a employer so that you assure that his cash flow will be credited to his account and you may be able to recover his money. So these 5 C's of good credit is also a good method of analyzing the creditworthiness or the risk of a retail credit customer. So I said counterparty risk is credit risk. Now say counterparty of a retail customer can be analyzed either scoring or 5 C's of good credit. I'm going to go to the next customer sector, and which is called SME, small medium enterprises. Those days this is a one chunk, but central bank found this, or the international risk manager found under this category of small and medium enterprises there are subcategories. Now central bank define small medium enterprise is a company which has a indebtedness or the borrowings less than 35 million, or they have an annual turnover of less than 600 million, which is a large amount considering that's when you say small medium enterprise. But that is the criteria of business. Any customer whose borrowings are less than 35 million and annual turnover is less than 600 million is classified as SME. Anyone who is above that are considered corporate clients. So, but going under current context, I divide these 3 sections into this particular sector into 3 categories. The first one is a micro industries or mass employed. That means a real retail customer who does a kind of a business. Micro businesses, you generally, like a welding plant, small grocery shop, they are generally, we call it mom and pop companies. So the family owned companies, generally owner himself manages, they don't employ anybody, people, they themselves, these are self-employed projects, majority underserved. Sometimes in this particular sector, banks are not gone and funded their financial requirements. But underserved means this is where money lenders will get in and fund them to make more money. Lack of financial reports and formal collateral. So these guys doesn't have securities, or they don't have audited statements or financial statements to show to the bank and ask him for a facility. When these guys are in operation for a little while, they come to the classical level of SME or real small medium enterprise level. They are typically retail trading still, sometimes owner managed, usually served by the banks under retail banking or consumer banking, or they are branch dependent. These guys are in certain townships, so the branch bank is the unit which actually fund their financial requirements. Once they grow bigger, they get into large SMEs or commercial establishments, which are not still categorized as corporates, but they are usually in business of high volumes, and we call it large SMEs. Usually, generally more than 5 years in operation. So you start doing business for 5 years, you build up to get into a kind of a commercial sector of a SME. These guys sometimes have multiple banking relationships. Now I want to ask you questions. If you are in front of me, I will be asking question and getting answers. Hope somebody can answer this. Multiple banking relationship means customer have two account, more than one account in the same township of two different bank branches. My question is, if you are a risk manager and you are in credit department in risk management, and they come and ask you, the best customer of yours who has actually considered the prime customer of your branch, and come and say, sir, I want to open an account in your competitor bank. They have approached me, therefore I would like to go there. What do you say? Do you allow him to go, or you would like to retain him only for yourself so that you could earn more money? So, however, now you see the situation, any given township has more than 10 branches of a single bank, 10 branches of different banks. So they compete each other, and there's a high competition, and business development units of one branch will approach your best customer and say, okay, we can give sun and the moon so that you come and bank with us. So sometimes these customers will fail for that. Now this customer has some kind of affiliation to your bank. So he comes and asks you, what do you say? Can I open another account in another branch of a different bank? A lot of bankers in the past actually answers this differently. They say you should never allow your best customer to move from here. As risk managers, my view is little different. Sometimes probably your best customer has taken most, is a diversified industry. He may have credit lines for various type of businesses. Some businesses may do well, some businesses may not do well. So you have taken a collateral, all what he could offer, and therefore he's the best customer, he's the highest value customer to you. Now this customer wants to go out, that means sometimes you may have reached the highest level of taking risk on this customer. Those situations, it's always better that you allow him to go so your risk can be minimized. And as a branch manager, I have done that because I know once these customers go there, your competitor sometimes take him on clean basis because in order to get the business. And if your customer, if there's a failure, he will stop paying the second bank which he opened first because he has not provided any collateral. So who will bleed? Your competitor will bleed because of your decision allowing for your customers to go to another bank. Sometimes you need to take these sort of strategic measures for reduction of risk. So these customers also, these customers, in order, if you are going to take, you have to have a very good relationship. Probably you may have to assign a separate officer to look into his affairs to analyze very closely the risk involved in doing business with him. And that's why at this moment, sometimes you transfer his facility to your corporate banking department. Yeah, his account will get allocated to a relationship manager. And generally, relationship managers will have about 20 to 30 accounts. As a result, they could evaluate and have a close tab on these customers. So moment you find the risky, you could actually take precautions and corrective measures. So this is the current SME sector, and the evaluation of risk in this is very typical because these sectors sometimes not have audited financial statements. Most of these customers, most probably, they prepare two sets of books. One for the bank, in that they will show profits. The other one for the inland revenue, they show losses so that they could avoid paying income taxes, and they show to the bank to get their facilities high. So you cannot completely rely on the financial reports provided by SME clientele. Therefore, you need various approaches to verify the creditworthiness or the financial analysis. Now, I have put 4 categories of how you evaluate SME client. SME client can be evaluated looking at his provided financials and looking at you make a business visit to his business premises and make a judgment whether he is managing it properly. If it is a retail sector establishment, you could, when you visit, you can ask few questions and you can determine whether they are in line, the answers are in line with the financials he provided. For example, you could ask, what is your daily average sale? And you know, generally these establishments are 24-hour everyday operation, and they will run for 30 days and 364 days. So if you can get the average sales into 364 is his top line, that is his revenue in his P&L. So immediately you can check his financial report and see whether it is matching that. So through various management processes, you can check whether the financials are in line with what he actually does. So you can make a judgment, give the facility or not. Repayment versus collateral. Sometimes customer insists saying, so I'll give you credit, I'll give you a security. Instead of giving the cash flow forecast, he gives the security. So I think as a banker, you should always verify the cash flows or the repayment capacity before insisting on collateral. So second criteria to look at is cash flow. And to arrive at that, instead of looking at the collateral, you need to actually build up a cash flow statement. Past record versus future prospects. Sometimes these SME customers find it difficult to run their businesses. But if he has got future orders, even their past record is not that attractive. I think we need to consider them in order to, evaluate proper. Company versus industry. Sometimes the his business may be in a bad industry, but he is doing well. We'll take, for example, he is in transport. His company may be a taxi service. And you looked at his company, he doesn't have assets. And this particular industry is doing well because now there are opportunities for delivery, transport people, and our transport systems are no good. People use it, taxi service as well. So he's in industry, his company may not have vehicles, he doesn't have assets, but he has outsourced so many and he's in a industry. So looking at that, you could actually do a proper evaluation whether you are going to give facilities. So in other words, SME evaluation is mainly your judgment, your gut feelings. So generally, SME risk can be evaluated only through looking at financials versus management, repayment versus collateral, all this will lead to, way of judging the client's creditworthiness. And you need to have gut feeling about the client based on the information what you gather, whether he will default or not. Therefore, this particular type of sector need very close monitoring. And in fact, in Sri Lanka, most of the facilities by banks are on SME credit. Therefore, we need to develop this area, and you need to advise the frontliners who are in the business the risk generally SME faces, like there's no market for their product, kind of thing. You need to actually evaluate. When you evaluate and then pass those information to the frontliners before they undertake facilities to these clients. So today I'm going to stop at this level, and we will move on to corporate credit evaluation next week, because this needs a thorough analysis, because corporate, we say they have financials. You generally lend on not the corporate name or whatever, you lend on their financial state, what is in their financial statements. So we developed various methods. One of the lenders' approach is a method called 4-step model, which we will discuss next week in thorough. And today I will stop at this moment, and thanks for your careful or concentrators listening. And we will be going through next 2 sessions, especially credit risk evaluation, because it's the highest form of risk to the bank. Thank you.